We just lived through one of the most historic weeks in American financial history. We didn't just have one, but two of the three biggest bank failures in US history happen within a single week. You had Silicon Valley Bank go down, Signature Bank go down, and even Silvergate Bank go down. Three banks going down within a 7-day period. This is not something that happens every single day. And already now you'll see headlines all over the place ranging from, people saying we need to protect the banks, we need to protect the depositors, to others fighting back saying, why are we bailing out the banks? We're bailing out the rich, we're bailing out the VCs, the tech bros, and so forth. But there's a lot of disconnect and miscommunication, and in fact, even misinformation that's out there. So I want to break down exactly what went on in the last week, what the government did, and what it really means for the future. So first, how did these banks get into this challenging water, right? Number one, the banks weren't exactly doing, risky investments. However, most of these banks, what they were doing is they were taking the customer deposits, right? The money that you give to the bank into your bank account, and they take that and then they purchase bonds. They go to the government and say, hey, I'm going to buy a 10-year bond from you where they might get paid 1% interest, right? They pay you 0.005, they make 1%, and so they make a spread and they actually make profit, right? That's how banks can make money. A lot of people say, why don't you just put the money in a vault? Well, guess what? You don't like paying monthly service fees. You don't like paying all kinds of fees. You don't like to pay your teller every time you see him, right? A lot of things at the bank are free, and so they need to make money somewhere, right? And the way they do that is by, essentially rehypothecating the money that you give them, right? They put it somewhere else. Now, why is it an issue? Well, usually it's not, because most banks, they structure the balance sheet where, let's say, X% is in long duration bonds, X% is highly liquid, X% is actually in cash, right? So that if somebody goes and says, I want to withdraw, they take it from the cash portion, and then as things free up again, they rebalance. The time when it doesn't work out is when there is a bank run, right? And what is a bank run? A bank run is when all of a sudden everybody goes and says, I want my money out, I want my money out, I want my money out. And then all of a sudden they spend all the cash. Now the bank is forced to sell some of those longer term assets, sometimes at a loss, sometimes not at a loss, right? In order to free liquidity, right? And those sales oftentimes become public, where then people see, hey, why is this bank selling off their assets? I guess they have a lot of people withdrawing. And so then they say, well, I might be better off also withdrawing. Now, usually they wouldn't be forced to sell at a loss because we've been operating a zero interest rate environment for a long time. But as you know, we've gone through the fastest rate hike in US history. And so what that means is that these bonds that the banks were sitting on are now worth less than their face value. Why? Because, well, if the bank has a bond that pays 1% over 10 years, but you can go to the market and get one that pays you 5%, why would you pay full price for them when you can get something better, right? So as a result, the banks were forced to sell these bonds, which are totally fine and have all the money if you wait till the end, right? At a loss, simply because of the opportunity cost. And so now people start tracking how much unrealized losses are these banks sitting on. And people start realizing, wow, some of these banks, like Silicon Valley Bank, for example, had essentially for every dollar in equity value, they had $1 in unrealized losses. And hence the run of the bank commenced. And now it's really tricky because on one hand, if we all waited till the bonds matured, everybody's money is safe. Everybody's money is there. Because ultimately those bonds and treasuries, they're backed by the US government. But because, people wanted their money out, all of a sudden they were forced to make a choice. We sell at a loss or we stop allowing redemptions. And essentially that's when the government had to step in. And they said, you know what, we're going to provide a near-term lending facility where we're able to lend banks for up to 1 year to overcome this hurdle, right? Because the US government recognizes that these assets are literally their own. It's their own treasuries, it's their own bonds. They know this asset is good for their money. It's not a toxic asset, but there was what's called a duration mismatch. Okay, so now that we figured out why this happened, right, and how it happened, the question now becomes, okay, should the government have stepped in? Look, it's no secret. You can go through the last 7 years or so of my online posting. I am a hardcore crypto person. And if anything, I should be celebrating that the banks are collapsing. 3 in a week. In fact, if the government hadn't stepped in, you probably would have seen, FRC go out of business, WAL, and several other banks. But the reality is that there's so much economic opportunity and societal cost that comes with the failure of banks. Why? It's not the bankers that are losing, it's the depositors. right? And so the beautiful thing that actually happened last week is that the stockholders and the executives of those banks, they did get punished because all of them got wiped out. They all went to zero. However, it's the depositors, the normal folk, right? Normal people, normal Americans, and also small businesses, medium-sized businesses, large businesses, everybody that thought, hey, I'm just using a checking account. I'm just putting money into my bank account because that's the safest place to put it, right? They would have gotten screwed if the government didn't step in. But the government said, you know what? Let's have the investors get wiped out. Let's have the bank executives get wiped out. But we're going to protect the people that just thought, I'm depositing my money. They weren't making risky investments. They were just saving their money somewhere. And the reason you can't let them fail is pretty simple. Something to the tune of 50% of venture-backed startups in the US were banking with Silicon Valley Bank. And I know there's a lot of bitter people out there. There's a lot of people that maybe hold some kind of grudge against Silicon Valley, against tech and so forth. And they were delighted at the idea that, hey, maybe they get punched in the face finally, right? But the reality is you do not want an entire generation of tech companies to get wiped out in a single week in the United States. That's the number one way to lose US hegemony, A, and number B, that's the perfect way to take our unemployment rate from 3% to 5%, 6% or higher. Why? Because that is a massive growth industry in the United States that would from one day to the next be wiped out. Now people say, oh, but there's the FDIC limit. Well, here's the thing. FDIC covers up to $250,000. That is a fantastic amount of money for an individual. But for business, it simply doesn't carry because if you have, let's say, 20 employees, right, and you have other business expenses, you will burn through that $250K in 2 to 4 weeks, and maybe if you're more frugal on those terms, perhaps in 2 months. Regardless, most companies can't operate with just 2 months of runway, right? Because they're growth companies. Growth companies, by definition, they don't make money right now. They're growing fast in the beginning on more capital, and then they become extremely profitable down the line. And so America had two choices. Option number one was letting an enormous amount of people go out of work, have an enormous amount of innovation and growth go to zero, and furthermore, have people lose every single remaining shred of trust in the banking system because it would not have stopped at Silicon Valley Bank. It would have not stopped at Silvergate or Signature, but rather people have said, well, if those three can fail, my regional bank can fail too. And here's the problem. From a game theory perspective, there is zero incentive and zero reward for staying loyal and staying with a certain bank. So instead what people do, they say, I'm not taking the chances. Let me take my money from FRC. Let me take my money from Customers Bank. Let me take my money from all these other regional banks that were on the come up and move it over to a global bank or a national bank, like a JP Morgan, a Bank of America, a Citi, a Wells Fargo, and so forth. And what you then end up seeing is that you have the entire regional banking sector get wiped out and power consolidate even more and more and more in the big four, in the too big to fail category. And that is not beneficial to anybody because not only would that further be detrimental to the US economy, because a lot of these regional banks have much better insight into their local geographies and are actually a core pillar to enabling lending to their regions. Whereas not everybody can just go to JP Morgan and get a loan and get services and so forth, right? We were literally looking, in my eyes, at a potential tech Armageddon, at a real 2008 financial crisis moment. But ironically enough, I think for once the Fed did the right thing, where they were able to avoid the situation by protecting depositors, but punishing the banks. Because ultimately, whoever held equity in those banks got wiped out, which means you are not incentivizing risky behavior, because risky behavior means you go to zero. We simply protect the customers. Now, beyond this, one of the most fascinating things to me is that in the aftermath of depositors getting protected, you saw crypto rally like it almost has never done before, where Bitcoin lifted from the 19,000s all the way up to close to 27,000. I think for once the US government made a wrong step. All of this started with, what's called Operation Choke Point, where the government was trying to, really kill the banking sector that's supporting the crypto industry. They started with putting pressure on Silvergate. They put pressure on Signature. And then even Silicon Valley Bank was a core piece. And within 1 week, they wiped up 3 pro-crypto banks. The mistake they made was that they thought that this would kill crypto. Instead, what it did was cause a massive bank run of epic proportions across the United States, causing a lack of trust in the banking system. And so now the US government is in this awkward lose-lose situation. You either let the banks fail, in which case people lose trust in the banking system and people go to where? Crypto. Or you step in, you put in protections, you back things up, which does have an easing effect from a monetary policy perspective. We saw the DXY, the dollar index, already drop in the aftermath of this, and all of a sudden risk assets go up. And so now it's a catch-22. You either let the banks fail, people go to crypto, or you ease and risk assets, which crypto belongs to, go up. And so what they thought was the perfect chess move to take out crypto ended up being the one thing that validates the very reason of its existence. And so it's been a crazy week, but I hope this provides some oversight and clarity on what went on. Is this a bailout? Was this really more supporting? And how does it play out in the big picture? Because ultimately, this last week is likely going to play a huge role in the next 12 months of what's going on in the global economy. And so I hope you enjoyed this video. As always, check out the description below where you can find a link to my latest newsletter where I share with you my thoughts on a weekly basis on what's going on in macro, tech, and so forth. And of course, as always, like and subscribe. I'll see you next time.